Hello everybody, good Sunday evening. Hope everyone had a great Thanksgiving weekend here in the United States. Elsewhere around the world had a good weekend. Here for the Sunday night, two things that grabbed my attention recently, Periscope. I'm going to jump right in. A couple quick things. First off, people are starting to notice the supply problem in the Treasury market. CNBC, worst week in 8 months, yet it was only good for a 3 basis point decline in the 10-year Treasury yield. Mohammed Al-Arian had a tweet noting that the yield on the 10-year government bond essentially unchanged despite volatility in stocks. Chris Kimball noting that stocks, crude oil fall, bonds fail to rally. Seems like something's going on. It's something we've touched on in a couple different periscopes, and we've been tweeting a lot about it over the last month and a half. The key is this, and this is very, very important this week and in coming weeks. As long as FX hedged Treasury yields are negative, the pressure on the U.S. to finance its own deficits, will continue to rise. It had already been rising. It went into hyperdrive when FX hedged Treasury yields went negative on a nominal basis. The U.S. can finance its own deficits, but it is likely not going to be able to do so with stocks trading where they are today. Stocks will likely have to go lower in order, if FX hedged Treasury yields remain negative. The only way out, or the only release valve to stop this, is a weaker dollar. Another way of saying this is that the dollar shortage is already acute. It's already too high. And it's important for this week because I believe we've got almost $200 billion in Treasury issuance coming out this week, which if FX hedge yields remain negative, probably not going to be a good week for stocks. And importantly, $200 billion in a week sounds like a lot. It is a lot. It's also just a little more than average of what the U.S. needs to issue on a gross basis for the next 52 weeks, assuming the economy doesn't soften at all and deficits rise. So things getting pretty acute there. Second thing I wanted to highlight, the Atlanta Fed took their GDP numbers down as stimulus and tax reform are rolling off, as oil prices are rolling off, as interest rates continue to bite, strong dollar continues to bite. They're now looking for 4Q GDP of 2.5%. What grabbed me about this, and I tweeted about it today, is that you got GDP growth at 2.5%. You got the U.S.'s weighted average borrowing rate at 2.52%. On debt that is 105% of GDP, and a debt balance that is growing by 5 to 6% of GDP CAGR, and is expected to continue to do so ad infinitum. And I'm not aware of any time that this has happened in U.S. history. We're truly operating in uncharted waters. You probably have to go back to World War II or perhaps earlier. And so when you tie it into the other point, it's just a very challenging environment. It's not going to be good for stocks or bonds until the dollar weakens. A couple quick things in terms of questions. I had a request to talk about the importance of the gold-oil ratio as it relates to the petrodollar. The bottom line there is a gold-to-oil ratio. Gold, how many barrels of oil per ounce of gold, is essentially a temperature gauge or a measure of the health of the petrodollar system. A low gold-to-oil ratio means a strong petrodollar system because gold prices are low. That removes competition for treasuries as a reserve asset, while oil prices are relatively high, and that creates dollar surpluses that then ultimately get recycled into not just oil surpluses in terms of the oil exporters that get recycled into U.S. financial assets, but it also creates demand for dollars from oil importing creditor nations like Germany and like China. And so a low gold to oil ratio means the petrodollar system is strong. A rising gold to oil ratio, however it is achieved, is a problem, suggests something is going wrong with the petrodollar system, or that its relative hold is weakening. So that's one of those. Secondly, had a question about a tweet regarding the Russia situation. Put a hashtag on the State Department oil market. that was more a timestamp for me. It helped me kind of get some thought process out there, solicit some feedback from FinTwit. The thing I would point you to is the State Department oil market is something we first wrote about in third quarter of 2014 when we did an analysis, and it looked at unplanned production outages in OPEC nations, and fascinatingly found that between sanctions and revolutions, etc., unplanned production outages in OPEC nations starting in 2010 essentially barrel for barrel provided an umbrella for the U.S. shale market to develop. So basically every OPEC unplanned production outage that went offline was replaced by a shale barrel. So it was and pretty much right on schedule, and that continued to 3Q14, and when that stopped happening, oil prices sort of fell apart for that and some other reasons as well. So that was a reference to that. Also had a question regarding the Saudi deal with China announced on Wednesday afternoon before Thanksgiving in the U.S. Basically just headlines in the Western media, not much detail on the deal at all. I would say a couple things. Two things grabbed me about it. I saw the headline. I really didn't think that much of it at first. They signed a lot of deals with Saudi. Then I saw that Saudi is overtaking Russia as the #1 supplier of China in 2019. And then I saw the volumes, which were 1.67 million barrels per day from Saudi to China. And understanding that that Russia was the #1 supplier. Russia overtook Saudi a couple years ago, aided by a willingness to sell oil in yuan. It raises questions about the terms of this deal between Saudi and Russia, and it's something we're watching very closely for, particularly given the broader context of the gold-to-oil ratio, which has gone from 15 to 25 in the last month, or nearly 25, and also, of course, the seemingly disproportionate response from the U.S. to the Khashoggi killing. So those are the things that have grabbed my attention at this point. Hey, Eric, how are you? Eric Carlos, good to see you again, sir. I have a question from Fed funds rates projections for 2019. I think the Fed, I think they're going to do one more hike and then see and have to pause and wait. I'll be very surprised. I saw something today. Goldman still thinks they're going to do four more rate hikes next year. Boy, I'd be surprised. The economy's already weakening pretty meaningfully. Housing's weakening pretty meaningfully. We're getting the headlines that, hey, OPEC needs to be afraid of Texas. I tweeted something about that. I remember reading that 4 years ago too, and that didn't work out so well for Texas. When we read those after oil had dropped from 75 to 50, and take it down another 10, 12 bucks, and things are going to start to get a bit hairy. Bottom line, to answer your question, I don't think there are going to be. I don't think they're going to do four. To me, I think that December they'll do, and then I wouldn't be surprised if they pause for a bit or talk more dovish at that point. I would be surprised if they don't do that. Let's see, from Eric, if gold is a reserve asset again, would that bode well for cryptocurrencies also? Possibly. I think it depends on how they're structured. I think it depends on how they're used. To me, I keep coming back to one sort of baseline truth, which is we need a neutral reserve asset to restructure the system. That neutral reserve asset needs to be written up tremendously relative to all fiat currencies to fix the system. There is currently only one neutral reserve asset sitting on every central bank's balance sheet, or virtually every central bank's balance sheet, and that's gold. And Eurasian central banks have been overwhelmingly buying or repatriating gold for 5 to 8 years. And so, to me, a killer app would probably be some sort of crypto married to gold, or married, gold in SDR married to crypto. I don't know how you do it. I think it could be part of the solution, but I think I ultimately am watching what central banks are doing, and what have been doing and continue to do is buy gold. OPEC falling apart. Hi, Doug. It's interesting when you look at if you only need OPEC if you sell oil in a single currency. Basically, if you're only selling oil in dollars, then you need a cartel because you need to restrict. The only thing you can control is supply. So you need to restrict supply to maximize your dollars. And so in a dollar monopoly for oil, you need OPEC. If you can sell oil in dollars or euro or yuan, suddenly your need for a cartel kind of goes away, because if you don't like dollars, then you go to euros, and if you feel like the euro is overpriced versus dollars, then you go back to dollars, or you sell in yuan. And ultimately, when you're talking about multiple different currencies, again, you go back to the reference point that's sitting at the top of everybody's balance sheet, which is gold, and that's why gold ultimately, I think, rises in oil terms as we transition towards a new system. But ultimately, OPEC falling apart, I think, could be a symptom of multi-currency oil pricing. You just, your incentives change dramatically as an oil exporter. Your relative power increases notably as an oil exporter, as an OPEC member, if you can sell oil in multiple currencies. S&P to commodity ratios, currently trading at all-time lows or near all-time lows. The two other times they were at all-time lows at these levels, you had major transitions in the currency system that led to a 4 to 5x increase in commodities versus the S&P in relatively short order. Those occurred in 1970-71 and in 1999-2000. I expect something similar to happen again. I think being overweight commodities and assets that would benefit from a weaker dollar or to do quite well over the next 5 years. That said, tying back to what we talked about earlier, if set par, if nothing changes, we're in sort of this dollar shortage, squeeze that is starting to squeeze the U.S. government too. Hi, Mark. Price of oil. Price of oil is. I'm assuming you mean what do I think is going to happen to it. I think ultimately we may be seeing, I don't want to say we are, I think we may be seeing the early signs of the petro-yuan coming of age as we speak. We've seen the gold to oil ratio go from 15 to nearly 25 in a month. We've seen that has been driven by the price of gold basically going nowhere and the price of oil collapsing. We've seen this Saudi-China deal announced where Russia's getting displaced all of a sudden on a big increase in Saudi business with China. I've heard multiple times that Saudi will do what they must to keep their biggest customer happy. That's China. And so if this is correct, if we are, and then of course the Khashoggi thing, which to me is a real red herring. It's tragic. I think it's terrible if the allegations are true, and certainly you've seen U.S. authorities saying that what happened. That said, it seems wildly disproportionate to any number of other things related to the U.S.-Saudi relationship over the last 20 years. And so why now leaves me scratching my head. Point being, if we are seeing the petro-yuan deal or the petro-yuan come of age as we speak, as there's 42 million barrels of open interest in the December contract and all of the aforementioned having taken place, then all of a sudden the price of oil becomes very dependent on the dollar, and in particular the dollar or the yuan-dollar ratio. In other words, if petro-yuan comes of age and the yuan falls against the dollar, then oil's got to fall in dollars, or else there's going to be a risk-free arbitrage able to be taken yuan-dollar through the oil link, because oil is convertible. The yuan is convertible under the oil contract in Shanghai. So if you have a viable, relatively, if it comes of age and the yuan falls against the dollar, if the yuan goes to 8 or 10, like some are saying they think it could, which I think is unlikely, but say it goes to 8, say it goes to 750. If oil doesn't crash, then I will be able to buy oil in Shanghai, take it to the U.S. and sell it in dollars and keep doing that and make risk-free profits, and that would close that gap. And so, to me, I think the key takeaway as you're thinking about oil is, in addition to sort of what everybody's talking about, I think people are selling short this yuan oil contract way too much, given at least in the mainstream media, given the importance for oil prices that it could ultimately drive. Hi, Eric Carlos. Could you describe the Eurodollar system, why so many people claim it's critical to global finance? It is the Eurodollar system, the way to think about a Eurodollar is effectively an offshore dollar. It was created out of a system of regulatory arbitrage in the 70s and has exploded. It's basically a dollar created out of thin air by an offshore bank that needs real dollars to settle. And it is the problem when you're creating dollars with no reserves effectively, or infinite leverage that need real dollars to settle, is that the dollar shortage becomes very pronounced. And so ultimately, if the U.S. will not supply those dollars when the economy turns down or when those loans start to go bad, then you're going to create dollar strengths at par. It's just the way the world has developed and worked, and it will create shortages. Ultimately, left to its own devices, as I noted, set par. The way to think about it is basically if you are Toyota Motors and you go to a bank in London and you want to borrow money in dollars and they lend you dollars. That's a Eurodollar. That is a offshore U.S. dollar. You got to have dollars to pay those back. So if all of a sudden the U.S. says to Toyota, you're not allowed to sell any cars anymore in the U.S., or we're going to put a 30% tariff on all your cars made outside the U.S., then suddenly your access to dollars that you were counting on to repay those dollar loans shrinks, and that less dollar supply. Continuous or steady dollar demand leads to a dollar short squeeze. And so that is the dynamic we're seeing. Left to its own devices, the system will collapse on itself. Trade credit will break down. It's literally the end game to that, if nobody ever steps in, is Mad Max. Basically you will go to the store, the shelves will be empty, the dollar will be at 160 or 200, and gasoline will be 30 cents a gallon, and there will be shortages all over. And so somewhere between where we are today and there, our bet at FFTT is that the authorities are going to step in, or that it will cause a crisis that creates the political cover for them to make a change to the structure of the global currency system, which is my bet, and my bet is that is sooner than most people think. It's a nice segue to the next question from Eric Carlos, which is, what advanced signals would one expect if the U.S. were to reopen the gold window? I don't know. I'd expect to see the U.S. Treasury Secretary go to Fort Knox like he did 18 months ago, maybe would be one. I'd expect to see central banks all around the world making sure they were repatriating their gold, buying gold. Of course, that's been happening. And I don't know if the U.S. is going to be the one to reopen the gold window. I would argue, based on global central bank reserve allocations, it's sort of already reopened. It just hasn't been marked to market yet. So maybe the better way to put it, is we're waiting for the gold window to be, or the gold moving through the window to be marked to market. But I think we're seeing some of those signs. But again, you need a crisis to make a big change, and that might be another advanced sign. So we'll see. Hi Andy, could we please talk briefly how I'd allocate assets for the year ahead? The thing that grabs me is that maybe I'll do this briefly. 90% of assets are down. Asset classes are down against the dollar in dollar terms year to date. That is the most in 120 years. The mean reversion side of me, and understanding that the United States absolutely needs asset prices to rise to drive consumer spending, to drive tax receipts, it strikes me as extraordinarily unlikely that we're going to have 2 straight years where 90% of assets are down against the dollar. And so, particularly when I look at commodities at 100-year lows relative to financial assets to the S&P, I want to be overweight, commodities, emerging markets, etc. As long as I'm cognizant that, look, the machinery in place as it is set and going right now is going to drive the dollar higher. The key question as we look out for 2019 is, A, do you think the authorities are going to let this thing basically grind itself into Armageddon and let the dollar get so strong that trade credit breaks down globally? Basically we have 2008 where no one does anything to stop the crisis. Or if we don't think that that's the case, which I don't, then when are they going to step in? And I think that's actually going to be sooner rather than later. Step in, provide dollar liquidity, or change the system. And under that circumstance, those circumstances, my bet is you'll see a lot of mean reversion of how well the let me rephrase. Those asset classes that did poorly, in particular in the last 6 to 9 months this year, will do quite well under those circumstances. So, okay, guys. Well, I'm going to jump off here. I appreciate you checking in. Sorry we had a couple technical difficulties. I don't know if something's going on with our Wi-Fi, or not even Wi-Fi because I'm plugged in here. But at any rate, FFTT-LLC for any more information. Otherwise, great catching up, and we'll do this again next Sunday night. Have a great night, guys.